and in a most practical way we have learned how we should utilize the weeks. That also we have discussed in the first session. You are experiencing that. Adjustment are of two types: pre-adjustment and post-adjustment. Pre-adjustment is done with the strategy with the objective to reduce your cost of deployment and same time to make the strategy feasible. So certain strategies has to be pre-adjusted and certain strategies need to be post-adjusted. So that is what we have learned. Then horizontal, vertical and diagonal spreads we have understood. One is a time spread, two different expiry options when it is involved. That is one kind of spread. When one expiry it is involved, it is one kind of spread, and diagonal spread, combination of both. Then we have learnt about the calendar spread rule. Four different types of called calendar spread we have learnt. Whenever we are forming a debit calendar along with a credit calendar, combinations, debit calendar in the lower strike, credit calendar in the higher strike. This is higher strike, this is lower strike. This is to gain from the downward gravity in the market and consolidation. Whenever we are forming a credit calendar along with the debit calendar, so this is for the upward market. So specifically in the call, when it is formed in the call, it is from the upward market, and gradually if market goes up, so we can make money. So calendar spreads, these two alternatives I have told you. Other two alternatives also there, and plain credit and debit calendar also there. So when the market is in the deep premium, this calendar need to be initiated by looking at the VIX. So this also you have learned. Then I have taken you to box spread with the option strategy. Box spread, here we have formed that 75% to 80% credit should be there. We should form a box spread and we should form a straddle, short straddle or short strangle based on the box to get the benefit of from that. So that is how we have learnt it. And when the market is in the deep premium, so that time I have suggested you form a credit half box spread in put option, and same time you should form a sell a call option or credit or bear call spread, bear call spread, bear call spread along with the bear call spread along with the credit put box spread. So this combination works out whenever market is in a deep premium. So other alternatives also we have learned. So different alternative we have learned. Then I have taken you to the bull bear spread, and there also I have told you whenever you are forming a bull bear spread, make it as a diagonal spread. So whenever you are forming a debit bull spread, it should have 1:1 risk reward. So 1:1 risk reward, debit bull spread. Then you are taking the credit bull spread in some higher strike, which is covering 100 to 125%, minimum 125%, not more than 150%, 150% premium or the risk what is there in the debit bull spread. So similar way, whenever you are coming in the put options, this rule is having a small tweaking, 100 to 125%. So this is also are there. Bull bear spread, if we initiate in that order, also we will get benefited. So here mostly, if I can say, that we are looking at the VIX. Based on the VIX, what kind of breakout it is giving. So based on that breakouts only we are initiating the things, or based on the VIX view only we are initiating the strategy, and we are following an approach of near to 95% of hedging. All these strategies whatever you learned, it is covering more than 95% of hedging. Means if you have 1 lakh, you are protecting your capital till 95,000. Only 5,000 rupees you are putting risk. If you make it 100%, you won't get benefit. That is what I told. Then I have told you the Z-score based pair trade system. So Z-score based pair test system is a excellent system. Excel I have given you, and you have been tracking it also. So you can say there Z-score once it comes to +2 or -2, you are initiating the trade. So these are the things we have discussed so far. 2 more sessions will complete these things. And many people, so initially, though some people are not serious, but post few sessions, many of the people started practicing on this concept very seriously, and I have got many messages with the backtesting. Many messages I got. Many of you have started practicing, and that is how you should grow. Now coming to our today's session, and once again, good morning to all of you. Today's session, I will be discussing the remaining subjects. So we will start with the weekly option strategy with adjustment. Then I will take you to the iron condor strategy. Two things I will be covering, and covered call strategy if it is there, that also I will be covering. And then tomorrow we'll have the last session where increase mastery option strategy and other things I will be covering. So when dealing with the weekly option strategy, weekly option is not a plain vanilla option. Weekly option is an entirely different instrument. So options are of different types, because whenever you are trading in the options, maybe you know that there is a call option and put options, but there are different types of options are there. So in India, we have monthly options, which is known as the plain vanilla options. Plain vanilla options. V for victory. So vanilla options are the monthly options. When it comes to the weekly options, that is known as the exotic options. So this is the plain vanilla options, exotic options. Then we have barrier option, we have basket options, we have knock-in and knockout options. So we have various category of options. Options are not restricted to call option and put option. Their types are different, pricing models are different. So plain vanilla options, whenever we are talking about, so we can use the Black-Scholes model, you can use the binomial model, you can use the trinomial model. So you can use any tetranomial model. So you can say these are the models you can utilize in the plain vanilla options. But when it comes to the exotic options never follow any pricing model. When it doesn't follow any pricing model, what is the problem? The delta of option can become greater than 1. So IV also can become greater than 100%. So these are the changes in the exotic option. On the day of expiry, you will see that many of your weekly options will having IV greater than 100. That means it says delta is greater than 1. So these are exotic options, toxic options. So they do not follow any of your formulas or pricing models. Then how it is being priced? It is priced by the people. Whatever people wants to offer, that will be priced in. So IV can be calculated, because for IV there is no formula, so we can back parse it. So we can find it out what is the IV is there. But only thing is that IV can go above 100%. When we accept IV is greater than 100%, that says we are also accepting delta is greater than 1 and delta is less than -1. So normal deviations, what is in the option pricing model, we are using one factor called ND1 and ND2. So this will come to infinity in weekly options. These two factors will come infinite in the weekly options. So these are the basic differences in the options, weekly options, specifically the instrument what we have. So for your knowledge sake, you can learn that what is a basket options. Basket options, you can say that only one tranche of, you can say strikes will be allowed. So you can say that this X2P, this particular strikes will be allowed. Once market penetrates this, then one more basket will open up. It's a basket options. And once you are doing in a basket options, you can only form strategies. You cannot take individual strikes. So whenever this particular basket is fixed, so there, whatever, if 10 different strikes are there, you cannot buy one strike or sell one strike. Trading cannot be done there. Anybody buys one strike, he has to sell one strike, or he has to do some counter trade in these particular strikes. All strategies can be done in this basket. Similar way, if this particular strike you are initiating, other basket strike also you cannot put, lower basket strike you cannot put. So that is called your basket options. Then we have barrier options. Means beyond particular things, the strikes will not be generated. Beyond particular move, barrier will be put. This is the maximum strike will be allowed for this month. For that entire cycle, no other strike will be created. So only that particular strikes will be allowed. 10-20 strikes. So the demand will be concentrated on that. And not only this basket will have this thing, in basket options you can fix your strike. So you are telling that I am having 50 paisa one strike, one basket. You create one and put it. If market accept it, that will be your basket. So you can put some orders, people will take it, and other baskets will start trading on that. So that is also allowed. Knock in and knockout option, what is there? The moment the underlying asset touches one price, that particular option will get exercised. Immediately it will get exercised. It won't wait for the expiry to happen. The option will get exercised the moment specific price, underlying price touches one specific level. So that is knock in and knockout. So these are the options so far not there in Indian to come. All these options are going to come to your market. Once these options comes to our market, the hedging will become more competitive. Hedging will become more serious. Hedging will become more, you can say, more lucrative. Profits only the people those who have learned, they will get the money. Others cannot able to make 1 rupee out of that. So these are the option types. So weekly options, as you understood, it is exotic options. Once we are talking about exotic options, here delta nothing is, we can calculate through the formula. But how, there is a delta also we can calculate. How? Suppose Nifty moved by 100 point and option moved up by 20 point. Any call option goes up by plus 20. So your delta will be 20 by 100 for that particular strike. So every change in the Nifty, how much change is come in these options, you just divide, get the delta. How is the theta? Whatever the time value will be there in the options, that divided by the number of days till expiry, that is your theta. How you will calculate the Vega in these weekly options? Suppose 1% change in the volatility happened, and due to that change, some X price movement happened in the Nifty. So during that, before change of volatility, what was the premium? After change of the volatility, what is the premium? That change in the premium divided by change in the price of underlying. So that will be your, sorry, change in the price of, change in the volatility, change in the premium divided by change in volatility. That is called your Vega. So these are the ways we can able to calculate. So calculate the delta, theta, Vega. So here once such kind of a straightforward calculations are there, neutralizing this strategy also difficult. You cannot neutralize this strategy. If you neutralize also, it will not be, it is not a regressive mathematics, it is simple mathematics, it is there. So that's why it is exotic. It is exotic. It is, you can say, some exotic fruits you are getting in the supermarket which doesn't grow in our region. We eat that. So similar way, exotic birds is there, exotic foods are there, exotic fishes are there. So something precious. So something precious, something you can say beyond knowledge, or beyond any rule, that is known as your exotic. So these particular options, if that kind of thing is there, why it is brought into Indian market? Because this is a very good tool for the risk mitigations. We can do a lot of hedgings here using these exotic options and monthly options also. So these are the things are the beneficial part of this. So we'll be so that is the cost of hedging also will come down because of this. So these are the benefits are there. So since this particular instrument doesn't have a direct method for formulations, direct method for pricings, so all option strategies what we are using in the monthly, we cannot use it here. Only special category of option strategies we can use it here. We can form similar strategies, but it will not be rewarding. We have to follow a extra caution while implementing these strategies. These are the parts we have to, because it is very quick, it is very feeble, it is very you can say very wicked instrument. It can behave very differently in a very short span of time. So for that we have to devise a special plan for this. So here couple of strategies which I have come across through a period of experimenting on this, period of trading on this, so that I'm going to tell you. So here debit call and put spread in current expiry with credit call and put spread in the near expiry. This is what you can form: debit call and put spread in current expiry, and near expiry you should have the credit call and put spread, that too with a post pre-adjustment process little, post adjustment process little. So that process you have to go on. Suppose in the July month, say we are starting from the 3rd July, 6th July, I am forming currently on 3rd July, Nifty is at 19,300. Say I am forming a debit call spread. I am going for 19,300 call option. I am buying one lot. I am going for some 150 or 200 point, any assumptions process. So here 6 July, again call option, one debit call spread. So 19,500 you can say. So 500 is too deep. So 85 to 15, you can say 75 risk. However, 125 rupees will be your lively profit. So say 6 July, 19,400 we can go. So it is very deep, it is becoming. So 400, 100 point. So here 40, if it goes here 40 is goes 45. So here risk reward is equal. So I am going for a call option sell. So this say it is a bull spread I am making, debit call spread or bull spread. If market goes up, I am going to make money. If market doesn't goes up, then I will not be making money. So now comes to same process, put options. Say I am going for a put option 19,000, say 19,000, 320. I have gone little in the money. So here I will also go little in the money. 350 put options I am buying. So little in the money, 20 rupees there in the money. Here also I am going the same way. So put option. So there also I have taken 100 point depth. Here also I will take 100 point depth. So 250 I am selling. So risk reward almost equal I made it. Now question comes, I have to follow two approaches here. Number one, I'll have a pre-adjustment. I'll also have a post-adjustment. Two approaches will be there. So what will be my pre-adjustment approach and what will be my post-adjustment approach? So have a risk reward analysis first. So here if you round it to 40 and it is 86, so 86 minus 40, it will be 46. So 46 is the risk and 54 is the reward. So 54 reward, 46 is the risk. So risk. So this is the risk side and this is the reward side. So here too also you can say 47, we can round it, 88 you can round it. So exact difference will be different, or 47, 87, if you can say that it is 40 rupees. So 40 is the risk and 60 is the reward. 60 is the reward. So this is what we are getting. Now next job is very crucial. what will be the pre-adjustment approach and what will be the post-adjustment approach. In pre-adjustment approach, whatever the risk is there, 46 rupees risk here, 40 rupees risk here, I'll take 75% of this risk in terms of credit. Means if it is I have 40 rupees, so 40 rupees means one share is coming to 10 rupees, so 30 rupees credit I should get from some credit put spread, so that my strategy should be feasible. So for that I am going for 13th July, and put option I have got 350, 250. So I will go for a put options much less than 250. So you can say 19,200 I can go, or I can go for 19,100 also, or even I can go for 19,000 also. So 19,000 put option I am selling here, one lot. So 19,000 or 19,050 also I can sell here, sell one lot. So how much I have to recover? 30 rupees I have to recover, 75%. So here sixth you can hedge, or 13th also you can hedge, but I will go with the 6th because I don't want to hold this position beyond 6. So this is the 19,050 I sold. Shall I go for the 19,000? Let me see. I should get 40 rupees. So 40 rupees I am not getting. So 950. So here 12. If I less it, I'm getting 33 rupees. So this I will buy one lot. So this also not exposed. So by this process, try to understand this part very carefully. So here you have got 40 rupees as a risk, 60 rupees as a reward. Out of this 40 rupees, I want 75% of the risk to be taken out from credit spread. So how much is there? 30 rupees I want, one fourth of this. Sorry, one fourth is left out. So each share, if I divide 40 into 4 segment, each share is coming 10, 10. So out of this 4 tens, I require 3 tens through the selling of specific or through credit option. So for that, what I have done, I sold 1950 put, bought 18950 put. By this process, I am getting 33 rupees and 20 paisa, almost same thing I got it. This process, the way I did, the same process I will be doing for the call also. Call I have 46 rupees risk, so that also I want back. So I will go slightly up. So here, that too also I am doing with the near expiry, not the current expiry. I am going for the near expiry. So call option. So here, what call option I will sell? That I should get 46 rupees, at least 46 rupees means 32 rupees I should get. So I can go for 19,600 call. Let me see. 500 call. Let me see. So 13th July, 500 call 50. So here 58. I'm selling it here. Here. And I am going for 6 July call options, and that too 19,600 or so. So here this is just a process by which you should get that money. So you can say I can go for 550 also. I require whatever I require, that much only I'll take. I won't take more than that. So here one, so I can make a sale here. So this is a sold position, this is bought position. So almost I got the similar kind of things. So 36, 39 rupees I am getting. Let me calculate the profit and loss. So this process of making it is only 3 days period. So little bit of timing part also I'll tell you. So 3rd of July we are entering. 3rd of July we are entering on the day of expiry, 6th of July. So these are the positions which has first day given 350 loss, 500 loss, settling at 50 rupees loss, because we have very feeble time, only 3 days time we have for this thing. So for that reason only what happens, we did not get enough movement, has not happened. You can say 322 to 497 it has gone. So call side we made some good gains here. However, put side we have a loss here. So you can say this adjustment, if it is not done, then it is some profit we would have got. Since the adjustment is being made, we are making a small losses here. So how to counter this? So for that reason only, any strategy, this is a, you have seen that only 3 days are there, so we have lost it. So any strategy you form in any time, in weekly option or monthly option, you should have minimum 5 days in your hand. Keep it in writing. Minimum 5 days you should have in hand to make it profitable. Why that minimum 5 days period or 1 week's entire trading cycle? What happens in options once the Monday the operation starts, or in the Monday your specific activity starts till Friday, Monday to Friday, theta decays little or rebalance or recops. That theta will have a small move. Only after Friday, when the Saturday Sunday encounters, so that particular week's theta will completely surrender or will go off. So that is the nature of theta. So always market behaves or move in a hope and aspiration. There is a hope tomorrow market will go up, there is a chance market will go up. So that hope used to be there till Friday. Once Friday happens, so that time theta surrenders, trader diminish that hope, they move to a next hope level. So that is the reason why we have to have a 5 days minimum. So if we are entering on 3rd of July, so what I have to do, I will do the same strategy but in a different way. You have seen that I have taken for the 6th, you have landed in loss. So I will be going for 13th July. 13th July call options I will be taking, same strike 19,300 I will be buying, and same 13 July. But here I require risk reward is same. So risk reward is same. So 300. Maybe I will go for the 19,500. So you can say, so 200 means you can say 100 risk, 100 reward. So this also sell. So now put also will have the similar things, but date will change. 13 July. When we are entering for 13 July? On 3rd July. So put, so these two also 19,350, same strike we are going. So here we bought, and 13th July put options we can go for 200 point also, because the risk reward will be favorable here. 1 2 we require 1:1, so 100 rupees risk, 100 rupees reward. So that kind of things we require. 50 rupees risk, 50 rupees reward. So 19,350, so we can go for 200 point less, 150, 19,150. See 63 means almost risk reward is slightly balanced here. 50, more than 50% we are getting. So this part is done now. But how challenges also changed. So here we have, you can say 96 rupees 50. If it goes another 5 rupees, 95 rupees is the risk here. How much? 95. Here how much? So 30 gone, again 33 from 100, so 70, 67 is risk. So risk also changed in call and put, risk change. Now out of this risk, how much we required? 75%. Say 100, so 75 rupees I required. If 95, 75 rupees I required. And here out of 67 or 70, you can say, so you can say for 15 to 15, almost 16 or 17. So 48 to 50 rupees I require. 75% of this risk. So whatever it comes, roughly you can calculate. So this 13 change. Now this also will change to 20th July. So near month, because this month will not give us that money. So near month will go, and here to call we have to sell. That call strike definitely 19,500 above. So we can go for 19,500, 600 or 700. 600 it is giving us this much. So 68 rupees. 68 rupees. The 20th July 19,600 call is giving us 68 rupees. How much we required? 75. So 75 will never come. So slightly we will go below 19,550. 86 rupees we are getting. So 86 rupees we are getting, and here to also call we have to hedge. So we'll go for 13th call, say 650, 19,650 just for hedging. You can go for 19,700 also. So slightly you have to take. So here 18, almost 70 rupees we are getting. So that, or 700 you can go, 750 you can go, because more is the credit you have to get. 75 rupees credit you have to get, 72 you are getting, well and good. Now we will be going for 20,000, 20th here put options. See, these are the things on what logic I am doing, that is important. In what logic, in what basis I am doing it, that is important. So here this is sell. So here 20th July, what I am doing, I am going to sell a put option which will be having a strike less than 19,150. So because my bear spread, I should not disturb, I should not interfere in bear spreads area. So for that I have to say 19,100. So how much I have to get? Almost 48 rupees I have to get. 19,100 is coming. So say I can say 13th July put option, I can 19,000 I can buy. So this is your choice. This adjustment, pre-adjustment is your choice. This is buy, this is sell. So 19,000 is coming too high. So 40 rupees we are getting. So 30 rupees we are getting. I can go for 18,900 or 18,800 also, nothing wrong, because here I want my credit should be there. Credit is more important for me, because here if I give a more debit, so then my problems will start because I cannot make money. So have a look here. So this process we have done. See, only we have changed the strikes. What we did? Only change the strike based on our convenience. So same spread is being initiated. Call spread initiated. Put spread initiated. You can say market in between this 19,322 to gone to 497, and from there it has fallen back to 403. There is a good consolidation happens. So you can say here first couple of days, one or two, first 2-3 days it was having a losses, and then after it has entered to a profit, and finally it is settling at a profit also. Finally on 13th July it is settling at a profit. So this is a pre-adjustment approach. What approach this one is? Pre-adjustment approach. So here what you have seen, you ignore this part. This part you ignore. This is a adjustment component. Pre we have allowed. Pre-adjustment we have done. So just we have changed the expiries. So expiries we have changed. Instead of in the credit we have taken, credit anyway we are going to take from the longer expiry, so we have done it. So that process. So suppose this pre-adjustment part we ignore, or we cut this pre-adjustment part. Next process also we have. What is that process? So first we will initiate this strategy. Only the debit call spread and debit put spread. We initiate it. Next day, so one wing will be at a profit, another wing it will be loss, anything will happen. So say first day 19,322 we initiated, it has gone to 19,389. So here it has entered to a profit. 389, this has entered to a profit and this has entered to a loss. This part entered to a loss. This is what happened. 389, just 50-60 point up. Call spread entering to the profit, put spread is entering to the losses. So this is what happened. The moment this call spread enters to the profit, the adjustment required for the call spread should be done. So adjustment required for the call spread should be done, because call spread adjustment is happening with this call spread 19,550 and 750 call spread. So the moment call spread enter to a profit, that time you should do the adjustment. So what will happen? Just have a look here. So put spread you are not doing any adjustment, only call spread you are doing the adjustment now. Say on 4th July, when the call spread has gone to a plus 700 rupees profit, you have done a adjustment for the call spread. Staged entry means 19,550 call is sold, 750 call is bought, or any higher strike, 600 sold, 500 bought, whatever is there, we have done that order. So post adjustment we are taking, post adjustment we are doing, and by this process what will happen? This 700 gain what has come. So here you can say that there is a 800 rupees loss is there. So that 800 rupees will not be there with us, because we are initiating on this date. So this date and this adjustment is no more, because this adjustment is not a part of our strategy now. So or this strategy will change. This 550 call will not be there, 750 will not be there, it may go to 600 or 700 also. So here, once the wing enter to a profit, any wing, if call enter to the profit, call side adjustment you do, put side adjustment no need to do, just keep waiting. Suppose post and touching this thing 989, all this thing, it has fallen back, it has fallen back. So you can say that 331 has happened here, 331 has happened. So once 331 has happened, you can say that this is end to end basis, but here we are saying that this is almost at equal. So equal, so that period on 7th July, on 7th July, this is closing basis. So day, some period of time, it could have gone to profit also, one small profit it could have gone. So on that time, so do this put adjustment, put adjustment on that time you should do, on that day you should do. So your call adjustment is done, put adjustment is done, but in a staged manner. If that doesn't come, forget it, only call adjustment is done, wait for that. So by this process, what will happen, profit will enhance, whatever the 1,200 you are getting, that profit will get enhanced. So two type of adjustment, pre-adjustment, do it, forget, then post adjustment, that is one process. Second, say you are doing a pre-adjustment, if you have more number of lots, this is one lot, very small ticket trade, say you cannot, you have to do the post adjustment, you can wait. But if I have 5,000 quantity here, bull spread 5,000, the way I used to initiate 1,000, 5,000, 2,000 like this, so I cannot take a risk for post adjustment. So what I'll do, so equal quantity I have to hedge, so 75% of quantity I will take. So 3,500 quantity I will have a pre-adjustment, 3,500 quantity I will have a pre-adjustment. Then I have 1,500 left out. So once the wing is, any wing enters to the profit, I will do a post adjustment of remaining 1,500 on that direction. So that is also you can do. Suppose if you have 4 lots, so 4 lots half, so two lots you can pre-adjustment you can do. Wait for the post adjustment any side to enter to the profit, then you do the post adjustment. So that process also you can follow. Any one process you have to follow. So this is the weekly options strategies, good rule. And similar things also, 2 days before also we had a Batman strategy formation, that also you can do. Batman also is a very good strategy, but it requires little higher money margin for that. So Batman strategy also you can do, so in weekly options. So this is the process of adjustment in weekly options. So again I will repeat, weekly options is exotic options, it has to be handled very carefully. Weekly options, all strategies are not useful. You can have a debit call and put spread in current expiry, and you can have a credit call and put spread in near expiry. It has to be done with a pre-adjustment or post-adjustment approach. In pre-adjustment approach, along with the strategy, you do the adjustment so that 75% of risk you should get from the credit. Why not 100% of risk? If you get 100% of the risk, then that strategy will behave like a butterfly strategy. 100% risk, butterfly strategy, only on consolidation time you can make money, not on the trending. If market makes a trending behavior, you cannot make money. So that part also you have to understand. So when we are making 75% of adjustment or 75% of value we are taking through credit, what we are conveying to the system, we still have a loss risk, and that risk, in case there is a 200 point up move or down move happened, then one of your spread will become matured and you will be getting a good profit out of that. And same process, that net profit will be bigger. So that also you have to keep in mind. Second, debit calendar and credit calendar spread also you can form. So this is, I have shown you this kind of, you can say how these arrangements are being done, so that it should be 13th, 20th, 13th, 20th with 75% of credit, how we have done it, so that we should be making some profit out of that. So this I have shown it here. Then we'll be going for a calendar spread. So calendar spread, whenever I am saying the calendar spread in the weekly options, that also follows a specific rule. Can anyone will tell me in calendar spread who is the profit given the weekly options are the most critical strategy? It looks very simple but very difficult. Very difficult strategy. Calendar spread. Calendar spread is the most difficult strategy in weekly options. But one thing you have to see, in calendar spread in weekly options, there is a secret. There is a small secret there. So that secret also I am going to tell how to form. So here what happens, I will be having a calendar, debit calendar and credit calendar spreads. First what I have done, I took a debit calendar. So how much debit is here? So you are saying that 60 minus, so here 46 minus 48 debit here, 48 debit here. So then I have a put option here where it is having 54.78. So 99 is gone. So 835, 7352. So 25 is the debit. 25 is the debit. Here 48 is the debit. 25 is the debit. 48 is the debit. So how much we have to keep the debit to make it comfortable? Make it comfortable. One thing you have to understand here, how much debit we have to make so that it should be comfortable. So here market is, as I sent to you one snapshot yesterday, someone has told me, my friend saying market is following the option price following the spot price. My friend or someone from your group has sent me. To clear his doubt, I have told. So have a look at here. You have a look at here. What is the Nifty spot? 19,467. Isn't it? So in Nifty option chains, whenever you see in the NSE option chains, these shaded colors are in the money options. These white colors are out of money options. So as per our understanding from the spot price, we can say 19,450 should be in the money option and 19th the money. That is what if spot is taken as a reference. If spot is taken as a reference, 19,450 should be in the money. In call, 19,500 should be in the money in the put. But what it says, 19,500 is in the money, 500 put is out of money. Why it says this? This is also weekly option. This is also weekly option, not monthly option. Coming week option, 17th August option. Why it says 19,500 is a coin in the money and 550 put is only in the money. 500 is not on the money. This is our spot price. So this clears your fundamental that option never follow the spot price. The option follows the future price. Till which date? Till the day of expiry. Till the day of expiry. On the day of expiry, the things will change. On the day of, only for that one single day, Nifty or options will follow the spot as the reference point, reference price. So on that day, you will see that in that particular option chain, they will show that based on the spot, everything will be in the money, out of money. That too also now afternoon only they are showing. That is not in the morning. So that is not wrong. It is a correct thing. Option price should be derived from future price. Future price, not from the spot price. That it is a asset. Underlying asset is Nifty spot. But while evaluating the price of options, evaluating the Greeks, evaluating the IV, future price should be taken into account, not spot price. But here also one more error is there. In NIFT NSE website, though they have given it correctly, this is in the money, this is in the money based on future. The IVs what they have calculated, they have taken spot price for calculating the IVs. See, the deviations are there. Spot price, that to Black and Scholes model. So there are many differences are there. Spot price is being taken to calculate the IVs. So IV should be calculated again using the future price. Now we have done this thing. We have found out the spread is here 48. So 48 rupees is the almost spread in the call, and 25 is the spread in the put. 48 is the spread here, 25 is the spread here. So this part, so call and put options we have done. So now question comes. We have to divide or reduce this spread to a comfortable level. There is a secret. What is that secret? In weekly options only this secret, not for monthly options. If the VIX is 11, very carefully listen. If VIX is 11 or VIX is 12 or VIX is 15, anything. So we are taking this debit call spread just 200 point above the Nifty spot. Again, debit put spread 200 point below the Nifty. So we are thinking that there is a 200 point of movement will happen till 13th of July. Beyond that also it can go. So if the VIX is 11, 12, 15 or anything, this debit should not cross two times of the VIX. If now VIX is 11, so now we are getting 48. 48 is not a good choice. We need to bring it to 22. 22 is the good choice. So we have to reduce it. Here 25 is there. Okay. So you can say 3 rupees deviation is there, but still we can reduce to something more. So this is the weekly option. You must ask me from where it has come. It is not given in any book. It is not, I have not read it anything anywhere. So anyway, anything which you have not read in anywhere, that you will learn in Smart Finance, that is a different thing. Why I did this, it is very important. For simplicity's sake, you can remember it. Okay, my VIX is this much, so my debit should not cross 22. I have to bring it down to 22. That is what I am telling you. If it is more than that, that means I am paying more for theta, and that theta is coming from where? That is also very important. On the day of expiry, this 19,100 put will follow. 13th July put will follow the spot price. On the day of expiry, on 13th July, 19,100 put will follow the 19th July spot price, but 20th July will be following the future price. Same for the call options. 13th July call options will follow the Nifty spot price on that day, on 13th. However, 20th will follow the future price. So this is the problems will happen when I have a huge premium of 100 to 150 point or more than 50-60 points. So to counter that, or theta will get disturbed, or to bring the theta to 5 rupees, or to make the delta to 0, because I have to make the delta as 0. Either way you can say. I can make the delta to 0, or I can make the theta to 5 rupees. So I have to devise a plan so that my theta should come to 5 rupees, and it is, so you can say what happens, delta has to be 0, and this 5 rupees of theta is required. So for that, what I am doing, I am reducing it. So how much is there? Call option we have paid 46, we have paid 48, we paid, we require 22, so we have to reduce it. So how much we have to reduce? 22 is there, means 6, 26 rupees credit we require. So for that, what I am doing, 17, so here call options. So here I'm 20 near to 22 rupees. I'm taking it back. So here, so here I'm selling this 19.7 call, buying 19.7 call back. So by this process, I'm bringing back some money. So 24 to 26 rupees I'm taking back. So it is based on this value. It is there. But put is not required. Put is not required because 25 it is there. So I don't require that. However, still I am taking for uniformity, I am just making a put. Also here also I am taking some credit. So by this process, if it is done, what will be the rewards from this strategy? One lot is being taken. So it maintains all these weights and gives you a profit. However, if you see this adjustment component, whatever we have sold, so this is the adjustment component. So call with call. So this part you can have a look here. So this part, have a look here, and this is adjustment component. This is the put part, you have a look here. So without these two parts, you will be having, you can see here 800, so 300, so here 300, 700, then it has almost become negative, then gone to slide positive, 500 negative, so 1000 rupees profit here. Our put is also killing here. So why the put is killing? Because this particular put of your July 20th is following the future price and one is following the spot price, so that imbalance is there. So this put, though call side is making money, put side is taking out your profits, so that is being compensated by this credit spreads. So by this process you are making some small profit. So one lot it is there, one lot to get 1000 rupees, it is a great money here. Hardly it requires 67 to 70,000. So 67,000 worth of investment you did, hardly 8 days you invested, and maximum gone to 1,300 or 400 rupees range. So that is a good money. 1,400 rupees gain you have gone in this. It is a good money, it is there. So 60,000 investment with something we have done small. So for remembering this weeks related things, what I have told, only for your simple remembering, how we should learn a trick so that we should remember how much we have to make this adjustment. How not a mathematical conclusion, nothing. It is just a rule that how much debit I should keep. So why I should keep that debit that much? Because my theta will be balanced. Why theta is in balance? Because the future is maintaining a premium, more than 100-point premium it maintains. That is making my thetas disturbed. So I should not take that. So that is for that reason only you have to make these things. So these two strategies keep following. Also, few days back, what I have done in the free webinar conducted for you, they are also what I have told you. So that process also you can follow. So that process also you can follow. So this is for your bull bear spread, and that is also calendar spread. I have told you. I have also told you how you can do a pre-adjustment and post-adjustment, and you can say weekly options are a wonderful instrument. Now it is 12% weeks, so little profit it is giving, but when it is 15% weeks, 20% weeks, this bull bear spread will give you every week 4% profit. This debit call spread, put spread in current expiry, credit this particular strategy will give you 3 to 4% profit per week, for week on week basis. So now debit calendar will give you this combination till 20% of weeks you can get 1 to 1.5%, 1.5%, 2% per week you can get out of that. But this one, once the weeks goes above 20, confidently take this one, debit call put spread. The way I told you, debit call put should be arranged 1:1 risk reward. 75% of the risk should be covered with the credit call and put. So depth will penetrate, the debit call or debit put will give you a full profit. So that process 3 to 4% per week you can earn. So that in was doing few months back, in the April-May month. Many of you, but one small group is being taken for that to show you the trades. I have done it, and this particular strategy for 4 weeks I did and shown you how we have how we have made the money. So this one is less than 20 weeks. You can do it. This you can do it. You can also do the Batman pattern also you can do. So that is 1 to 1.5% you can get per week. But this is a profit, very good profit making strategy. More than 20% weeks, 15% also goes, it will work. If it is more than 15% goes also, this will penetration, that debit call spread or put spread should penetrate, completely give you profit. So that also is a very good strategy. So that's this you have studied now. Now we'll move to one more strategy, that it is, you can say, iron condor strategy. Many of you have, you can say, I said that iron condor strategy and box spread strategy, mostly both are same. Only thing is that in the box spread, all the strike of options are in the money. Iron condor, all are out of money or partially out of money. That is known as iron condor. So it is having a VR call spread and a long iron condor, short iron condor. This kind of things are there. What is the basics of this iron condor? Also, that I have given some small snapshot here. You can read on your free time. But how to implement? That is very important. Iron condor also is a profitable strategy. How to implement it? How to pre-adjust it or post-adjust it? First, to implementation, you can see VIX estimate the price range. Based on the VIX, find out the price range. Find out the price termination points. Sell the call option, put option in termination point. Add both premium received, net premium received plus call strike. This net premium received and OTM call strike. So these are you have to do. Not necessarily you should do in the same month. You can go for near month. Say now VIX based estimation we did 766 590 points of movement expected in the month of 590 point of movement expected in the month of August beginning, where we have been 19,300 and something we are there, or 400. So this VIX based things, you can say 300 for example say. Now 600 point is coming 19,900 in the upside, and again 600 point if you less it from here, 300 gone, 18,700 put, 18,700 put, 19,900 call. Not necessarily August, sell the September, September you sell, because you have to slightly change this iron condor. Then say here you got 200 rupees as a premium, here you got 100 rupees as a premium, add this 300, so 300, so 20,200 call option, 20,200 call option you can buy, and here 200 300 you can say that 18,400 put option you can buy for the month of August. That you can do. So that you can do. Bank Nifty and other stocks, you cannot calculate the VIX. VIX requires specific data. It is not there. I'll give you a method to that. I forgot it. So please remind me on the Monday. So I will be giving you a small generic method how you can estimate the VIX like value for the Bank Nifty. But VIX, Bank Nifty VIX we are coming with. So we are calculating. We are in the process of making that. So in few months time our softwares also will give you the Bank Nifty VIX you will get. So this is how, if you benefit the calendar iron condor, then you will get benefit. How? So look at these values and tell me. Say now you can say now what is the India VIX? 11.56. Yesterday's Nifty was closing however spot basis. Nifty closed where? So next shape 12th August to 12th September we want. So NSE VIX or India VIX. India VIX, how much? 11.52. 11.52. I want to initiate Monday one iron condor type of strategy. It will get a revision also. 11.52 is yearly, so I have to bring it to monthly. So divided by square root of 365. So 11th to 12th to 12th. So that doesn't mean that we will be month beginning we will take. 12th we are sitting till 12th September we want. So somewhere we are sitting. So this is for Delhi. Then we'll be going for this into square root of 30. So 30 days, coming 30 days. So theta decay also will be very good. So this is the percentage form, it is there. Divide it by 100. So this is the value we got. Now square root of 30. So here same process it is done here. Square root of 30 into multiplied of this. So these particular things we have to multiply with 19,428. So coming 30 days we are having a movement of 642 points. 642 points of move we can get in the coming 30 days period from 12th August to 12th September. That is what it says. So based on that, decide the strike. This added with 641, this subtracted from 641. 18, 786, 20, 65. So you can sell now. For September we are going for, so sell the October 5 to October you sell, October you sell here, September you hedge, October you sell. So what is the October premiums? Nearest price will go nearest 20,000. So this process if you do only this strategy also it will work. So this 600 point of move is not going to happen one day. It will take time. So definitely theta will have an impact. So October also open. So 20,050. So 20,000 call option is there, 260 rupees. So October 20,000 C at 260, sell it off. Then you go with 18,700 of put of October, 26th October, 18,700 or what is coming? 18,800. 18,800 put of October, 124. So 124, 18,800 put October is 124. So total net how much you have received? 384. Now decide the next strike. So you have to hedge it. So 20,000 strike added with 384. Then you have 18,800 minus 384. So beyond that you have this thing. So you buy 20,350 or 20,400 call, 20,400 call of September. Call of September to hedge it. Same way buy 18,400 put of September. So this completes your iron condor in a different way. So 18,400. So go to the September. You are going to hold till 12th of September. So 18,400, 38 rupees here. So 38 rupees you are getting. 20,400 also will be getting similar thing, 47. So here 38 you are buying, 47 rupees you are buying. Over. So this part you have done. So now when to exit. When to exit this strategy, very important. When to exit, tell me. If profit doesn't come, when we should exit out of this strategy? Quickly tell. Anything comes in your, if this particular strategy goes wrong, where mid of the strike. So here 18,400 put you have bought, 18,800 you sold. So there is mid 600, 18,600, 600 quit. Same way 20,400 this thing 20,200 quit. Because beyond that what will happen? Beyond that what happen? Delta will spoil your show and losses will be more. So this point you will have the minimum losses. So by this point you should come out. If you want to play little more safe, what you have to do? Instead of buying a 20,400 call, buy 20,200 call. Instead of buying 18,400 put, buy 18,600 put. So little safe, but that will also again reduce your profitability. Enter like this. If it goes against, you have to quit the trade here. If it is consolidating between 20,000 to 18,500 till 12th of September 2023, you can make money. If VIX goes up, losses also will be more. So it is neutral, market neutral strategy. It is neither bullish strategy, not bear strategy, market neutral strategy. You are telling to the system, we are going to swing between 20,000 to 18,800. Based on the VIX, it has come. Okay. So this is what you should do. One more thing also you can do with this. One more thing also you can do this. This also try. Iron condor you have formed. You form a plain bull spread and bear spread where current strike. Bull spread and bear spread in September strike where currently Nifty is where 19,400. September, because you are selling October. So September or October, September you can take 19,400. August you can swing the 19,400 call and 19,400 put of September you can buy. So there is a 600 point it is giving. Take half of that. So 300. So buy and 19,700 call. This is September because October you are going to sell 19,000 call you can sell and 300 point it is coming here 19,100 put also you can sell. So in bull call spread and bear put spread you can form one lot. If you are forming, if it is one lot, then you can have two lots or three lots of the iron condor. 3 lots and 3 lots or 2 lots also you can have. 2 lots is more safer. 2 lots and 2 lots of iron condor. So if you make it, and if you are following the delta and theta, make delta as 0, and theta as 5. So that these things to increase in such a way that delta should be 0, theta should be 5. It may be 2 lots, it may be 3 lots. Have a bull spread, bull call spread and bear put spread, and have iron condor multiple. Delta should be 0. Sometime 1.5 also will come, 2 will come, but not 1 to 1. More than that, 1.5, 2, 2.5, 3. So anything. So iron condor will be there as it is in multiple lots. One bull call spread, bear put spread should be added in between. If you do that, what will happen? This is for September you are taking, but October you are selling. By this process, if you do, what will happen? So by this process, if you can do that, what will happen? In case the VIX increases, in case delta is taken care of, in case VIX increases, or in case this price penetrates the 20,000 or penetrates 18,800, strategy will not go to loss. Iron condor benefit will be intact, and same time you can utilize this. Even though if it is given, you cannot use it because that has a great deal of complexities, and it is having kind of arrange money. But one thing is very sure in option trading. Keep it in mind. Option trading, correct implementation will never give you losses. Never. If you correctly implement, zero loss you will get. Correctly implement. Correctly, if you make adjustment, you will get zero loss. No loss will come there. Only thing is that you need to practice and practice and practice. You need to learn and learn and learn. You need to test and test and test. If you do not test, if you do not practice, if you do not learn, if you still have an intraday mindset, if you still have a mindset which can give you unlimited money with unlimited risk, option strategy trade not for you. If you are taking too much of risk for getting too much of return, then option strategy trades will disappoint you. You will not enjoy that. You will not be happy with that. If you are not happy with that, you cannot make money. That is a fact. Anything. If you are not happy with the food, you cannot eat. If you are not happy with your family, you cannot go there, you will fight. If you are not happy with your study, you will not get a good job. If you are not happy with your money, what you earn, you will not have a prosperous life. Anything which you are not happy with, you will not get. Compulsion will not give you anything. If you lost money in the market, I always say that forget it. Why? Don't think that past. If you go on thinking, present will be painful. Past, if you go on thinking, present will be painful. Present also will not allow you to live. Past is gone. You cannot recover it back. Forget. Forget. Past, if it is gone, it is gone. So here option strategies are very cool trades. It will test your patience. It will test you to the extreme. Keep sticking to it. So those who have taken the pair trade from the month of July, see how much patience it has tested us. Yesterday we come out with profit. 1.5 months it has tested. Lot of write this option, buy this option, protect your, cap your profit. It was playing a cat and mouse game. So finally yesterday we come out with the profit. You will not lose. That is of sure. If you study properly options, 1 rupee will not skip out of your pocket. 1 rupee will not skip. Too much greed, you are not fit for option trade. Intraday mindset, you are not fit for option trade. You are too much in hurried state of mind, you are not fit for option trade. You have to make your mind too much controlled. You have to be happy. You have to be very happy inside. Then only inside, not outside, inside. You do not show your happiness to anyone. Doesn't require. Inside you should be happy. You should be joyful. Then option trades will give you abundant money, which you cannot expect. That much it will give you. You do not fix a scale that I want 5,000 profit from this strategy. Always risk, reward, risk, reward, risk, reward. Like this way you are going to. Risk is there, control the risk. That's all, your job is done. You can, if there is a risk, you control. Their job is done. What reward is coming, it is market is going to give. If you just focus in one thing, risk is there, control the risk, manage the risk, then forget. Then you will see that it will give you wonderful results. Wonderful results. That I personally experienced. Bit by bit I experienced in option trade. And those who have joined my earlier programs, many people, you are old participants, I have shown you what kind of money I made. I have never showcased that to anyone, because that is nothing to, it will add fuel to your greed. It is not going to give you any learning. So I do not showcase that. But I made abundant money out of that. Abundant. What is the secret? Nothing. Same thing what I am teaching you, same thing I follow. I never follow anything other than this. No special software. Have you seen, this is my desktop, have you seen any special chart graph? Red candle dancing, blue candle falling. I have never seen candles from the past 20 years. I use my system, no other system. Same system, mix based system, volatility based system. This is the system. and having so much of positions, 5 to 6 crores of positions also, I don't sit in front of system for 24 hours. Just specific level I study and come out. That's all. But what is the things? You have to be very, very happy inside. Then option trading will give you happiness. No, nothing, no relationship with the weekly strategy Arindam Das ji. So option trading is like that. Option trading is very important. That's why I used to tell those who wants to go for option trading what I used to tell in earlier program. Quit intraday. In intraday, you have taken a risk which is much bigger for that 6.5 hours of trading. Have 50,000 taken 5 lakhs trade. Definitely you should be worried. I should be worried. Everyone should be worried. So that is a thought. So that is programmed in our mind. So our thought driven by that. So once your thought driven by that, you cannot do option strategy trading. Impossible. If you do, you will fail. You cannot count delta theta vega. You cannot have patience for that. Normally it reflects. Many times I used to tell to Nanesji, Nanesji, you are too much hurried, too much panicked. I used to tell. In different group, I used to automatically tell. Because yes, get off little bit of intraday involves in his thought. Obvious, it is natural. That won't work out. So that won't work out in the option strategy trade. Fine. We'll again meet at 11:30 in Hindi session and we'll do it. So, so Ram Kumarji done a great study. He's studying that twice, thrice in a month after profit with 5 days of expiry. So he has done it. So some other things also tomorrow we'll see how we can make money in other strategies, like how we can form a covered call strategy, how we can have uh, your Christmas tree strategy, all these things, another 2, 3 strategies are there. These many strategies are enough for you. If you practice in the practice tool, that this is enough. This itself is enough. I am using only 2 to 3 out of that. So that